shall now start with the webinar. So I request Divyani to kindly introduce our resource person.
Good morning, everyone. My name is Sirakaji from SYBBAFS of VVM Shri Damodar College of Commerce and Economics. I'm going to introduce today's resource person. Mr. Pankaj Pai Kakode is a chartered accountant. He has started his firm, Kakode Consultants Private Limited. He is currently serving as a director at Kakode Consultants Private Limited since 2014. The firm is engaged in wealth management and management consulting. In the wealth management space, it handles holistic financial matters of families and helps secure its future. To add up to Mr. Pankaj Pai Kakode's credit, he has successfully helped a startup raise capital besides enter into a strategic tie-up. He has reviewed and implemented internal control systems in a boutique resort. He has helped increase the sales and reach for a chemical company, also advised four real estate companies in the areas of RERA. We welcome you, sir.
Thank you, Divyani. Now I request our resource person, Mr. Pankaj Pai Kakode, to kindly take over the session.
Yeah, thank you, ma'am. Good afternoon or good morning, still another 9-10 minutes to go for the afternoon to begin. Very honestly, this is my first webinar, so please excuse me if this is not very effective. I'm not pretty used to doing this on the web. I'm more adept at face-to-face conversations. Having said that, today's topic is about working capital, and the way we are going to do about it is I don't know how the question answer session is going to happen. So are we going to take questions in between or at the end? I'm free to do it either ways, whatever you guys are comfortable. So feel free to stop me at any point in time and ask any questions that you have. The way we are going to look at the working capital things is practically what is the meaning of working capital first, the factors that affect working capital, the components that go into making the working capital, what is a working capital cycle, how can you fund working capital, and finally what are the things that you should look at when you're looking at working capital, that is the financial aspects. Generally we look at that from the ratios perspective. So I've been given a time of about 45 minutes. I really don't know whether the entire thing will be able to do justice to that in 45 minutes, but I'll try my best. I guess the more conversations we have, the better it is going to be for the rest of the class or whoever it is to understand what the meaning of working capital would eventually look like. Now, working capital. So it's basically a capital that keeps on working. So that's the basic definition of working capital, which I like to tell my clients as well as the people who I consult. And today I'm assuming I'm giving a lecture to students, so I'll try and elaborate on what I mean by capital that works. So so basically, when somebody starts a business, there are two aspects to that business. One is the fixed capital that is required, and one is the day-to-day operations that are required, which is not so fixed. So what are those things which are not working capital? If we get that out of our system, then it is easier to concentrate on what we can call as the working capital. Now, assume we want to start a business. I love to give examples, so I'll try and elaborate everything through the point of view of examples and probably the real life examples. So, which you can probably go and do some research and find out if what I say is correct or wrong. So, what is it that basically is not working capital? So, anything which is probably long term in nature is not working capital. So when you speak of, let us say, a firm which is, let's say, a trading firm, for example, the store that they are going to have is not going to be the working capital. So whatever is the amount of money, or let us say a pharmacy for that matter, in a pharmacy, the store is definitely not a working capital. The furniture is not working capital. So what becomes working capital is the day-to-day assets which are required to run the business is a working capital. Now that could be the stocks, that could be the money that is required, that could be the credit that you've given to the market. If these three things will generally constitute the working capital aspects of the organization. Now, what are the factors? Is everybody clear with this basic definition of working capital? How do I get a response? I mean, is there some way of raising hands or something like that? Hello.
Students, if you all have any questions, please unmute your mic and you can ask so
Yeah,
directly.
please. Rather, everybody could keep their mics on mute. I have no problems with that. More the noise, the better it is. Yeah. So the factors that go in for working capital. So there are basically two factors. Some are internal to the organization, and some are external to the organization. Let's go with the external factors first. One is the government policies. Those are the basic, meaning unless and until the government decides. For example, if you are all products of the millennium, so I'll take you a little back. So prior to 1991, if anybody wanted to do business in India, it had to have a lot of licenses. So government would decide as to how much is the amount of production that was possible, what is the business that you could get into. Now, depending on the amount of production that you could get into, you would require your working capital requirement. For example, Bajaj Chetak, if anybody knows that scooter, had a waiting period of 10 years as the government wasn't letting it allow to increase its production. Now, because of those limitations, the working capital for Bajaj Auto was pretty limited. So they, in spite of having opportunities to grow, they couldn't grow the business, and they still had less working capital requirements as a reason for that. Technology changes. For example, Amazon has disrupted the business. Today, what a storekeeper probably would have wanted to store, let us say, 1,000 units. Today, he says, I'll buy from, say, something like a Metro, which is another competitor for Amazon in the wholesale space, or an Udaan, if anybody knows, is another competitor for Amazon. So they buy not in that great a quantity as probably say 5 years back. So technology disruption also affects working capital requirements. Business cycles. Now this is more so prevalent in the commodity space, or let the classic example is, let us say, umbrellas. When does a trader or a storekeeper will hold or buy more amount of umbrellas? Probably just before the monsoons. Nobody is going to buy umbrellas probably in December or January. Especially, I'm speaking in the context of Goa, because the businesses then would be not in terms of uh, the demand for umbrellas would be much lesser in the months of January, February, March. So his working capital requirement will come in a cycle. So his working capital for umbrellas to stock them would be required in the month of May, probably end April or May, and it will go on till about September, October. After that, he doesn't have that requirement for those monies. So basically, externally, we have about 3 or 4 factors. One is the business cycle, which is kind of the umbrellas example. One is the technology changes, which could be anything. For example, at a point in time, classic example is Uber. At a point in time, companies used to give vehicles to their employees. Today, they say you just Uber it out. It is we don't need to maintain the vehicles. We don't need to, kind of have the maintenance cost, the driver cost. You can Uber it and we'll expense that amount out. So technology changes affects. Today there is a company called as Dial 4242, which is kind of disrupting the ambulance market. Or there is lots of startups. For example, there is a company which is coming up called as Elderly, which is going and giving services for senior citizens. So a lot of companies come up with technology things which is disrupting the working capital cycle of bigger nature. The biggest disruption in the retail trade, which will come in the coming years, and I'm making a forward-looking statement, is JioMart. Now, JioMart is basically Amazon with the help of Kirana stores. What they are saying is we are going to tie up with the Kirana stores. They are not going to stock anything. They are just going to play the facilitator, give the technology and forward it. So the working capital requirement for Amazon vis-a-vis JioMart is going to be very different. So these are just examples of technology. Then the government policies. Every time the government comes up with something, government is the biggest restrictor for business. If government decides to get out of business, for example, today the Supreme Court has said you cannot shift mining ore out of Goa. So that much amount of working capital of those companies is getting blocked. So it's the government policies, technology, business. These are not. This is not an exhaustive list. This is just uh, a certain amount of it. And finally, taxes. The only thing which is certain is apart from that is taxes. So GST and direct taxes, more so in terms of working capital, it is the indirect taxes. So from a plethora of taxes till 2016, from excise to central sales tax to VAT and local excise, we are now down to only about three, which is customs, GST, and local excise. Apart from that, all are gone. But you need to provide for those taxes as well. So because of GST, a lot of working capital has been reduced from the firm's balance sheets to the extent of those taxation implications. So the external factors. Now, what are the internal factors? It's going to be the nature of business and the size of business. It's going to be the credit policy and it's going to be the operational efficiency. These are the three basic examples, and I'll give you an example of each and every, and please go and have a look at them, what I'm trying to say. Now, nature and size, whether it is a Kirana store, or what kind of a business you're doing will firstly determine what kind of working capital you require. Example is if you're doing a trading business, within trading, if you're doing a retail business, you need to stock up to ensure that when the customer comes into your store, you have that amount of material lying with you so that you can service that customer. So generally, your requirement for working capital in terms of stock is much higher for a retailer vis-a-vis the wholesaler, and I'm relating this to the sales that you have. For a wholesaler, he knows he's generally doing it against the order of the retailers. So his requirement for working capital in terms of stocks would be that much less. Now, this is in terms of trading. Now, assume if you are a technology company, do you need to stock anything? You don't need to. So their working capital would be very limited to the extent of the salaries that they might have to pay, and they might have about 3 to 4 months of salaries in cash or liquid cash or liquid products which they might be stocking. So the requirement again will be determined by the nature of the business first, and secondly the size. For example, if you are a retailer and you are a single store retailer in Margam vis-a-vis Avenue Supermart, has anybody heard of Avenue Supermart? It's not there in Goa at the moment. It's more famous by the name of DMart. So DMart is the brand, Avenue Supermart is the name of the company. So DMart is a multi-store. I think it has about some 700, 800 stores. So their requirements would be about 800 times more than one store that would be operating in Goa, right? So the size of the business. Reliance is today the biggest retailer having 27,000 stores. So vis-a-vis a DMart, Reliance retail would require probably that much more amount of money in terms of the stocks that it carries, the people that it has to pay, and so on and so forth. So the nature and size of the business first. Second is the credit policy. Now assume there are two businesses who are in the same business. Let's take technology business. One is, let us say, Infosys, and other is, let us say, a Persistent. Um, if the credit policy of Infosys is say, okay, you pay me an advance, and at every stage of time you pay me certain amount of money. The kind of working capital requirement would be much less, because they would then be realizing the money at a much faster pace. So they don't have the they don't have to provide for the entire project to get over. They don't have to pay the salaries out of their own pocket. Now, I'm assuming this. Let us assume Persistent is lenient with its collection of money and says, we'll not take any advance, and we will kind of take money probably, after 30% of the project is done. Persistent then would require a lot more working capital vis-a-vis um, let us say, Infosys. Another way is if both are tech companies. Anybody heard of Ramco Systems? Okay, I think I'll have to do this monotonous. Okay, Ramco Systems is basically a IT company just like Infosys, but rather than giving services, it is having its own product. So for them, it is they just sell a product. They have their cost already sunk, which is the cost for manufacturing that product, which is an ERP basically. And now it is just a matter of maintaining that ERP, which is small tweaking about that ERP, and then subsequently, kind of just selling and doing an incremental sale for that. So in that sense, the kind of business, the nature of the business, and the credit policy, how fast you collect the money vis-a-vis how longer you take to collect the money, will kind of determine how much amount of working capital. And finally, the operational efficiency. So what do we mean by operational efficiency? Operational efficiency means how stringently can you manage your operations, uh, uh, how stringently can you manage the operations. So, for example, Hindustan Lever is the best example for operational efficiency. I would I would really urge all of you all to go and look at the balance sheet of Hindustan Unilever. It is about a 30,000 crore company, and it is a company which has got a negative working capital. So the question is, how do they manage that? They don't give any credit, and they ensure that they pay their suppliers after about 35 days. So they are using their creditors, their suppliers' money to manage their entire working capital cycle and still be cash positive on that. So in that sense, Hindustan Unilever is a benchmark when it comes to operational efficiency, and it actually gets reflected in its share price. Its return on capital employed, if you look, is about 84%, which is a stupendous number for the size of the operations that they carry. So the factors, finally boiling down, the factors that affect working capital are internal and external. Within internal, it is the nature and size, the credit policy, and the operational efficiency. Externally, it is the business cycle, the technology, and the government. And finally, one of the most important external factors is the taxes. Now, any questions till here? Am I making sense or am I not making sense? Because I can't seem to ask anybody any questions and I can't see any faces. I'm kind of, I don't know whether it's going the right way. Should I continue? Hello?
Yes, sir, you may continue.
Yeah. So
Yes, sir.
what is working capital So the next part is the components of working capital management. Basically, working capital will be consisting of just 4 components. The most important is the inventory management. The second is the receivable management. The third is the payables management, and lastly, it's the cash management. Now, I have touched upon briefly in each of this, and I will relate it along with this to the ratios that you can probably look at, some of the ratios that you can look at when you're trying to manage the components of the working capital. What do we mean by inventory management? So, inventory, I presume everybody knows, is the stock that you carry in the business. So the more more amount of stock that you carry in the business, the more working capital you would require, and less amount of stock that you carry in the business, less amount of working capital that you would require. Now, for every kind of a business, there is generally a benchmark to which you can go. For example, a wholesaler versus a retailer is a classic example. A retailer generally carries about 3 months of inventory. Can a wholesaler afford to do for a 3 months inventory? Everything gets again related to the cost of everything gets related to the cost of capital over here, and the efficiency of the working capital will then be determined appropriately. I'll try and give you an example, which is again a real life example. Now assume there is a business which gives you, say, a gross margin of 5%, just a 5% gross margin, but you don't need to stock anything for that. So it's a classic business to be in, because if you don't need to stock, that gross margin, and assuming your receivables are zero, is your straight net profit, meaning minus your normal operating costs. You, at a gross level, it's contributing the entire 5% to your gross margins. So that becomes a good business. Vis-a-vis, now let us say there is a business where it gives you a 50%. Let us take an example of, say, Louis Vuitton or a Montblanc pen. Not many people can afford to buy a Louis Vuitton purse which starts at 80,000 rupees, or a Montblanc pen which starts at, say, 20,000 rupees. So that person who is retailing that will have to stock that over a long period of time. So probably once in 5 months, somebody might walk into a store and buy one purse of Louis Vuitton or a Montblanc bag. So if he's assuming he's carrying three, then his inventory turnover ratio is about 3 times. So 80,000 invested with a, say, 50% margin, 40,000 will take a much longer. So your return on capital then becomes roughly 40,000 divided by 3, which is about 15-16%. So eventually it is a mixture of the kind of margins that you carry, and secondly the kind of inventory turnover ratio that you generate. Now the first ratio, let me introduce, is the inventory turnover ratio. So when you're looking at managing inventory, the most important ratio that you need to do is the inventory turnover ratio. Inventory turnover ratio is basically nothing but how many times you are able to rotate the inventory. For example, let us say there is a business which is doing 100 rupee of sale, and the inventory there is, say, 20 rupees. Then 100 divided by 20 is your inventory turnover ratio. Higher the amount of inventory turnover ratio, more efficient is the business. So every business should ideally aspire to have a much higher inventory turnover ratio. Now, the trade-off here for the inventory turnover ratio to be high is the loss of sale that you can suffer. For example, just because I want, say, a 50 inventory turnover ratio, what do? I stock less. So that has an opportunity cost of a lost sale. So the trade-off for an higher inventory turnover ratio is loss of sale and loss of margin there. So you have to balance out your inventory turnover ratio with the sales loss that you might have to incur. So ideal situation is not lose any sale and have as high a inventory turnover ratio as possible. Now that is going to come from experience. It is going to come from uh, uh, doing a lot of analysis of the inventories that you carry. So one of the methods to do that is something called as an ABC analysis, which I don't think I can cover in this talk over here. The second is the receivables management. Receivables is nothing but debtors. How faster can I collect the money from the debtors would determine the kind of working capital requirement that I have. And that is again a very important part of that critical cycle of managing working capital. The faster I collect, the better it is and more efficient it is. Like I said, Unilever doesn't even give a single days of credit. ITC again is in a similar business as Unilever minus the cigarettes. They give about 8 days, 10 days of credit. So whatever is the kind they would require on a 30,000, 8 days is a huge number. So how you calculate that is 30,000 divided by 365 multiplied by 8. And that would be the kind of working capital requirement that you would require for ITC, which would be zero for Unilever. So it helps release cash in the system, and because it helps release cash in the system, the company is able to earn more money because they can then deploy that money somewhere else. So that is the second. How do you measure that? Is the number of days the total receivables are outstanding. So that is one of the most key numbers that people look at when they are looking at the debtors turnover ratio or when they're looking at the debtors. So a good analyst or a good businessman will ensure that the number of days my money is outstanding in the market is much less compared to what the lower that, the better it is compared to my competitors, because that gives me an edge over my competitors. So that is the second part. Third is the payables. Payables is basically for the creditors. So creditors are people who give you, who supply goods and services to you. It is just the opposite of debtors. So ideally, if you have a longer debtors period, it is bad for your business. But if you have a longer credit period, it is good for your business. This again depends on your bargaining power. Unilever can afford to tell people, boss, I'm going to pay you after 30 days or 45 days. If you are a small, assume you are buying from Unilever, do you have the bandwidth to kind of negotiate with Unilever and say, no, I'm going to pay you after 30 days? They'll say, I'm not going to supply you. So it depends on that as well. So it again depends on your bargaining power, your nature of business, and so on and so forth. Logically, the longer you take to pay your suppliers, the better it is for the business, because then I can sell the product that I'm stocking, I can collect the money, and then I can pay. That we are going to cover in the working capital cycle. So that is the last part. The last part of the last component of working capital is the cash management. By cash, what we mean is the liquid money that the companies carry. Usually, good companies carry about 2 months of liquidity to the minimum, and which has been emphasized during the times of COVID. If everybody has seen, from March 25 till I think May 31st, India was on a lockdown. Companies which were not having this proper cash management system would have suffered much more than people who had cash management in their prudent cash management policies. So never neglect cash management. It is called as contingency funds as well. Where you park that money is a separate story. You should never keep that money in your current account. Basically deploy that money in some place which will kind of give you some amount of return. But primary thing would be the safety of those funds where you park them, and second would be the liquidity. You should have access to that money even generally at 24 hours notice or any given day of the time. Considering banks operate 24/7 these days, and through net banking facilities, you can park them in something like a short-term liquid fund or a CP or something, if you're a big organization or corporate paper or something like that. So these are basically the components of working capital. Unless and until somebody asks me a question, I think I'll go forward and go to the next cycle. So which is a cycle of working capital. So what is a cycle? So basically a cycle of working capital is a cash to cash cycle, as we call it. So what do we mean by a cash to cash cycle? When you start a business, you have cash. From that cash, you buy inventory. Along the way, you sell it. You create debtors. To buy inventory, you have creditors. So it is basically the number of days you stock the time you require cash to be regenerated into cash is called as the working capital cycle. Now it is basically number of inventory days, number of debtors days minus the number of creditors days. So that will give you a cash cycle. The shorter the cash cycle, the better it is for the business, because your working capital to that extent would be reduced. For example, let us say a person is having a 20-day debtors plus a 20 days inventory, and he is having a 10-day creditor cycle. His net working capital cycle would be a 30-day, which is 20-day inventory, 20-day debtors minus 10 days would be a 30-day, 20 plus 20 minus 10. Now, for the same kind of a business, if another person is having, say, a 10-day debtors, a 10-day inventory, and a 30-day creditors, he is having a minus 10, and that would be an example of Unilever. So basically, then you are not putting any money of your own into the working capital cycle. So it's basically called as a cash to cash cycle or a working capital management cycle. I like to generally call it a cash to cash cycle, and lower the number of days, the better it is for you to kind of the better efficiency of the business that you would be looking at. Any questions still here? Am I going too fast? Am I going too slow? Is it making sense? I'm not getting any feedback, so I really don't know. Can I continue?
Yes, sir, you may continue.
Yeah.
Yes, sir.
Okay. So the last two parts is how do we fund working capital, and then lastly, apart from the small number of ratios that I mentioned, what are the other ratios that one should be looking at? So the working capital funding is basically broadly divided into two types. One is long-term funding and second is short-term funding. Now, what should form a part of long-term funding and what should form a part of short-term funding, and how do you finance the same will play a critical role in the stability of your business. Now, what do I mean by long-term funding, and why does working capital also require long-term funding? Best examples are retail businesses. For a retail business, you would definitely need a base amount of stock. Now, that base amount of stock requirement should come from long-term funding. And those long-term stock funding is generally sourced through either equity, which is your own money, or a long-term debt. Generally, anything above 7 years is considered as a long-term debt. For small businesses, anything more than 5 years and more is considered as a long-term debt. For large businesses, it's generally 7 years or plus. So your base working capital, which at any point in time below which you would not be going, should be funded through either your own money or through long-term capital, which is long-term borrowings. What is your short-term funding? Short-term funding is basically, for example, during Christmas, some people, or during any festival, some people might be wanting to stock more. For example, a food retailer might want to increase his stocks during Diwali or Christmas. That small gap up in the funding requirements for having extra stock during that short period of time is basically short-term working capital requirements, and that's funded generally through cash credit or short-term bank borrowings, which could be generally less than 5 years, or something like a cash credit or an overdraft facility. The other way to fund that is through trade credit, which is what Unilever does, classic example, or through bill discounting. Anybody knows what is a bill discounting? I'll just take a minute. For example, bill discounting is nothing but there is, let us take the case of Unilever. Unilever is not willing to give me credit. So what I do is I go to the bank with the Unilever bill and say, boss, this is a bill that I need to pay. I'm expecting so much amount of sales to come within. Please discount this for me. For example, against that Unilever bill, I have sold some material to say XYZ, say ITC. So ITC bankers know is a very great paymaster. So I take that bill which I have raised on ITC, go to the bank and say, this ITC is due to pay me in 1 month's time. You deduct 1 month's interest and you give me the money. Generally not available to small time business people. It generally goes to people who can do businesses above 50 crore rupees. This facility is more easily available through bankers. So bill discounting is one very widely used and generally used in export trade, more in terms of letter of credits. Finally, I think I'm on time. Finally, it is about the ratios that you need to look at. two very important ratios of working capital is something called as a current ratio and the liquid ratio. What do you mean by current ratio? Working capital, because it is short term in nature, it is called as a current ratio. It is basically your current assets in proportion to your current liabilities. So higher the number, more stable is the business. So analysts or people who look at businesses from outside look at these two numbers very critically. They give you the solvency of the business and the going concern of the business. For example, if these ratios are very skewed out negatively, then people would tend to look at those businesses very adversely. When I say that, it is in relation to everything else. So you cannot look at these ratios in isolation, but generally current ratio and liquid ratio. So current ratio is nothing but current assets, which is your all the current assets like your inventory, debtors, some loans and advances that you might have on the balance sheet, in proportion to your current liabilities, which could be your GST payables and your creditors. Generally, this would get clubbed. Uh, Current assets would also include your cash. Liquid ratio is something which is immediately converted into cash. So generally minus obviously your creditors. So liquid ratio is generally basically your current assets. Generally assumed is your subtracted from that current assets is basically inventory. So it's current assets minus inventory in proportion to your current liabilities. I personally, when I look at companies, also try and deduct what is the portion of bad debts or doubtful debts which is there, because that is something that you cannot convert easily into liquid. If you look at a balance sheet, they would say any debtors more than 6 months and less than 6 months. So I generally negate everything which is more than 6 months when I look at those things. The other, this is debtors turnover ratio, inventory turnover ratio, and cash conversion ratio, which I have already touched upon. So I think I was given time till 12:30. We are at around that time. I would encourage questions if anybody has them, because I've really run through the entire talk that I wanted to give. I'm very inadept at doing this. I'm doing this for the first time, so excuse me if it's not been to the par. But I think I'm more comfortable doing it in person. Any questions would be more than welcome.
Students, if you have any questions to the resource person, you all may unmute your mic and ask directly.
So there is a famous saying, when somebody has no questions, it means only one thing. Either they've understood everything or they've understood nothing. So I am very scared today that nobody has understood anything.
Students, please unmute your mic and ask questions. If you have any doubts, want to ask any questions, please ask. Or you may write in the chat box. If you have any questions, students, please write in the chat box.
No questions, sir. Okay. Somebody said no questions. So when are the normal classes resuming this year? Are they resuming, or we are forever like this for this entire academic year?
So as of now, we have not got any notification like when we are going to have a classroom lecturing. So as of now, we are having online lecturing only.
Okay, so somebody has asked a question, Granville. Thanks, Granville, for asking. How long is short-term funding? Now, when you're starting a business, short-term funding is considered anything lower than 5 years. Generally, you enter into a business to kind of do it over a long term. So long term is more than, for a small business, it is considered more than 5 years. For a big business, it is considered generally above 10 years, medium size above 7 years. So there is nothing which is fixed. It depends on the scale of the business. In India specifically, and I'm referring to the MSME sector, which could go up to 200 crores in turnover. Anything below 5 years is considered as short term. So 5 years is generally the benchmark which bankers look at in terms of long term and short term. I hope that is good for you. And short term could be anywhere between 0 days to 5 years now. So it's not necessary that it has to be 5 years. The example that I gave you was about a 2-month or a 3-month window.
Any more questions, students?
Is it good to have too much cash availability in the business or not? Okay. Good. So I'll answer Devyani's question first, and then I'll come to Granville again. So is it good to have too much cash availability in the business or not? So it has to be a balance, and for the simple reason is, see, when you look at the business, why do you do business? You do business to make money. How do you measure that? It is generally a return on capital employed. Now, if I'm going too technical, please write in the chat saying that it's too technical and you can't understand, and I'll try and explain. So you generally do business to make money. So when you have cash, is that making any money? You're not gonna make, unless and until you want to invest it somewhere else, which is a different ball game. You're not gonna make more than 4.5%, 5%, 6%. So it is going to overall impact your returns as a whole on the business. So you should have ideal amount of money in your business as cash. Too much amount of cash is also bad. If anybody is following the market, I'll give you a live example. ITC is holding on to 34,000 crores of cash as of today on its balance sheet. When I say as of today, as of 31st March balance sheet. Now, if you look at the share price of ITC, it is underperforming. One of the reasons it is underperforming is because ITC does not know how to deploy this money effectively. Counter that with a company called as Unilever or Colgate. They are efficient in deploying their money. So if you don't know how to use it, either refund it to the shareholders or deploy it at a place which will give you maximum returns. When I say maximum return, it is in relation to the cost of capital. The cost of capital is not only your borrowing costs, it is also your cost of equity. So a live example is ITC. So it's not doing well on the markets, but it's a great company. And it is not, people are not trying to give you any valuation for the cash that it is carrying, which is a significant amount. 34,000 crores is not a small amount by any standards for any size of business. We are looking at about $5 billion, which is huge. So they don't know what to do with that money. It is earning them about 4.5%, 5% returns, which is pulling down the entire return on capital employed for ITC. And that is why ITC is not doing well. Just to give you an example, ITC's return on capital employed is around 28%. Compare that with around 84% for Unilever. So that is what happens when you have too much amount of cash also on your balance sheet. So too much, it is required, but it is not, you shouldn't have too much of it also. Now, Granville's question was, how do we determine working capital when we start a business? So when you start a business, Granville, you need to assume you generally would end up making a lot of assumptions. Now, those assumptions would be in terms of sales. It would be in terms of primarily in terms of sales. Now, from that basis, you would rework all the numbers downwards, and that is how you would arrive at the working capital requirement. For example, I don't know what kind of a business you're intending to start, and I would be happy if you're intending to start one, because we do need business people in India. Is let us say a simple store that if you want to start, a simple store, you would be assuming certain amount of sale. Now, from that sale, you would have to rework your numbers and arrive at a working capital requirement. So the alternate to that is, having invested X amount of money in the working capital to make it run efficiently, you would then have to find ways and means of increasing your sale. So ideally, based on your assumption, you arrive at a working capital number, and that number would be sales. It will also depend on the kind of deals that you strike. For example, if you are a known person in the community and people are willing to extend credit to you, your working capital goes down. Vis-a-vis, if nobody knows you, they'll say, I'm not willing to give you any credit upfront, and for that you will need to pay me in advance. So your working capital goes up to that extent. So it depends on a lot of factors, but primarily it will depend on the kind of assumptions that you make when you start a business. Is that good for you, Granville? Any other questions? I'm happy two people asked. Ajo.
Any more questions, students? Please write in the chat box.
You can ask, unmute, ask. It's better here. Right?
Or you may unmute your mic and ask the questions.
Generally, meaning I'm taking classes, I think for the last 3 years, I generally try and make in a normal class into a question answer session. It's never a monotonous kind of a thing. So I'm very unused to all this. So.
Yes, any more questions, students?
Any more? No, sir. Okay. That's Devyani saying. Anybody else?
Okay, so since there are no more questions, so thank you very much.
Pleasure.
For this wonderful
I guess these are
session.
tech issues that come in, but I hope it was okay. My first experience online, so I only hope it's okay.
Yeah, thank you very much, sir, for this wonderful session. The knowledge that you have shared among the students, definitely.
I really don't know whether I've been able to share anything because I can't see their faces.
No, the knowledge
class you can make out.
Yeah, they will definitely be able to put that into practice. Thank you very much, sir. I would request and have a nice